Hi everyone, welcome back to the 14th episode of the Learn, Invest, Grow show. I'm Tay and my partner Adam's here as well. Joining us today is a special guest, Joseph Puggi. He's sales director at TCS Management Services. TCS is the largest full-service scatter-site property management company in the tri-state area, headquartered in Philadelphia, and it's currently managing over 3,000 single-family rental units. Hi, Joseph. Thanks for coming to our show. You're the very first guest on our show. Very, very special.
Yeah,
I
thank
feel
you.
honored. Thanks, Adam and Tay, for inviting me on.
Yeah, of course. Yeah. Joseph, so we recently noted there's been a lot of discussions in the real estate community on whether housing crisis will likely be coming next year. So people talk about upcoming expirations of moratoriums on evictions and foreclosure, and also speculate regarding the timing and size of the stimulus package. So obviously, there's no way of knowing how this contingency will play out. So putting them aside for now, so we like to focus more on current fundamentals and what you see in your day-to-day business. So Joseph, so as a property manager, so you deal with many renters and landlords every day in your business. So do you see any trends or metrics that could signal an early sign of housing crisis? For example, how has the rent collection rate changed over the last few months?
So what's interesting, as everyone knows, with the stimulus that was brought on, at first when everything happens, we didn't know, right? We still don't know what's kind of going to come on down the road. But our data showed what we've seen through the bulk of COVID throughout the summer months was the rent collection pretty much stayed on par, which the national average was 91%, which was on par with us. With that being said, stimulus is kind of still in talks right now. We're waiting on the next round. The additional $600 a week that people were getting for unemployment had ended in August. September was pretty on par. October and November, we are definitely noticing about a 1% to 2% decrease. Beyond this, don't know what's going to happen, but we're definitely noticing nothing that's alarming at the moment, but you're definitely noticing a slight decrease in the rent collection rate at the moment.
That's actually good to hear because I'm seeing, headlines, the crisis, like you listen to the news and like what's really going on. So that's why it's great to have you on this show. So we actually have someone that's in the trenches that could give us what they see from managing over 3,000 units. So this is great.
Yeah, and I think one thing that's kind of driving the quote unquote stability of the current rent collection being on par is at least I can personally speak on behalf of what we manage. We manage a lot of workforce housing in the area. Average rents around $1,200 for a single family home. Most of our residents are, the famous word of 2020, right? Essential workers. So, whether it's mechanics, healthcare workers, big box retail workers, restaurant workers, for the most part, yeah, in the beginning, that stimulus probably helped, but we're back in another lockdown, at least in the area at the moment, but it's not as strict as it used to be. So, I think that's playing a part in it too, is they weren't affected as bad as, you have your small business restaurants that are definitely being affected, but like I said, our residents mostly are working for big box companies that have weathered the storm for the most part.
That's it. That's an interesting note. So, I remember we had this conversation before that it really depends upon the employment of your tenant.
Yeah, and I mean, kind of, with our investors, with our assets that we manage, when we're marketing a property and we bring applicants to them that we go over and qualify, you're definitely noticing an increase on paying attention to basically what industry they're working in, right? That's playing a part in it, where before it's always, 3 times the rent is the default for income. You want to know no evictions in the last 5 years. Job history and stability is always a key factor, but more and more now too is what industry are they actually working in? And if and how would they be affected to pay rent going forward if we went into a full lockdown again?
That is actually, that's good to know for landlords that are future, existing landlords and future landlords to come. This is good stuff to know. Tay, what else? I know we have a lot of.
I'm personally curious. So we kind of touched upon the tenant side, right? So I mean, fortunately, the rent collection rate kind of still remain as good as it was before. But from the landlord perspective, do you see many motivated landlords who want to sell their investment properties recently?
So when it first started back in March, April, the first couple weeks was kind of like oh no, what's going to happen? And, people kind of wanted to do the quote unquote fire sale. What's interesting is that has not really occurred lately. If anything, we're actually seeing a lot of competition. You're seeing a lot of institutional investors jump in, which again is just driving the prices and the demand up. So you're having, even portfolios throughout the summer into the fall were just flying off the shelves, so to speak, very quickly. What I can say now is there's been a slight, I don't want to say stall, but slowdown, and we're starting to see portfolios sit on the market a little longer than the rate they were, through the course of the year. So I think you have a lot of people kind of, since it all ties into stimulus, and kind of people are waiting to see what's going to happen next. I even had a few investors that I deal with directly that I know scheduled to close end of summer have pushed stuff back to, last month into this month just to kind of get through COVID a little longer to see what's going to happen.
Okay.
So I think you're starting to see a slight slowdown. At least I could, again, personally speak for the Philadelphia region. Portfolio wise, stuff's starting to sit a little longer than it was, a few months ago.
Okay. And so now, do you think that, let's say 2021, do you think we're going to see a shift of more sales coming? Or I guess let's play out different scenarios, right? So let's say there is a stimulus package, right? Let's say there is that $600 a month that comes back. Let's say, what do you think would happen? Or if there is no stimulus, let's run different scenarios for 2021, because people are saying, oh, there's this crash coming, but are we really going to see a crisis? This crisis, is it for tenants? Is it for landlords? Is it for values? There's a lot of different things that, because crisis is such a strong word.
Right.
The world's coming to an end.
I don't think it's going to be anything like 08. Again, I don't have a crystal ball.
Yeah.
But it's interesting, right? So you have COVID, which is uncharted territory. You also have, as a culture, we're becoming a renter nation, so to speak, right?
Yep.
So that's driving the demand for rental properties, which, as we know, Wall Street's jumping into as well because they see that demand's there and it's upticking. I don't know if it's going to be a crisis where it, again, there's so many people out of work that we're in a U-shaped recovery. I don't know. Again, I think it really all comes down to stimulus, how many people trust the vaccine, get it out, and we can get our lives back to normal. Because the dust hasn't settled yet, right? We're still in that storm. We're still in the unknown. But what's interesting too is, interest rates are at an all-time low. So, that's what's driving the seller's market too, because there's no inventory, because houses aren't lasting that long on the market, at least from a home ownership side.
Sure.
So how should you compare these like potential crisis, if any, with the previous financial crisis in terms of like a scale and like severity? Yeah.
I don't think it's going to be as severe as '08. I mean, '08, as you know, was, obviously the housing market crumbled, which then just trickled out and put us into a bad recession where a lot of people are out of work. I personally don't think it's going to get to that point. I really don't. I think we learned enough from then that, underwriting guidelines are more stricter now too. So you're not going to see that, people are out of equity, and that there's going to be fire sales. I don't think that the economy is going to just completely tank either to '08 levels. I really don't.
Well, fundamentally, we're a different environment, because '08 was led up to loose underwriting with lending. I mean, that's really what happened, and owners didn't have any; they had no equity. So that really. So you
have no equity. They had no employment, so they couldn't pay. The banks were stuck with these these homes that weren't even close to the value that they were lending on, which just it was the trickle down effect, right? And it just moved out and affected almost every industry.
And then and what's really interesting is that like '08, for example. I mean, I was reading, you read articles, you had Wall Street firms like Blackstone, they're literally going to the auctions, right? So the question is, now, this could be for another topic, but, the question is, like, this environment may be different for, let's say if you're a landlord, right? Current landlords are most likely, it depends upon their financials, like if they actually have like, reserves, maybe they're equity rich but cash poor. But the question is, what do we? So if like back then, landlords are now new landlords came, but now they're currently, they're going through this scenario. I guess the risk is that depending upon if they're over leveraged, depending upon if they have reserves to cover themselves, and then, they have equity. So they're most likely, you would think maybe it would maybe a forced sale. I don't see foreclosures coming for landlords on residential. I think it's going to be more forced sales because they don't have the cash to cover, themselves during this eviction moratorium. And maybe they have other assets that are struggling. So if anything, it's just, we're probably going to see a lot of sales, but I don't see a lot of foreclosures happening. What do you think? What do you see on your take on, like, because I know you had the private equity firm, an affiliate company, and really you're trying to figure out, okay, where are we going to find deals? How are we going to buy?
Right. So the well-versed investors, like you said, they're going to, if they want to get out, they're going to sell. It's not going to, I don't think it'll come to a foreclosure.
Yeah.
I mean, opportunity is probably a bad word to say, but where you're going to be able to find homes that maybe go to auction or foreclosure are going to be the one-off investors that aren't diversified. So if they, say have 5 houses, right? 3 of them are delinquent, 2 are paying. Chances are they're not going to be able to keep up with any debt service they may have, and they have to get out. If they can't get out and they hold on, then yeah, maybe the foreclosures start to occur. But I don't think it's going to be, like we said, the fire sale.
And probably, when you see housing crisis, you're thinking the rental market's going to crumble, or all of a sudden you have, values are going to crumble, right? I don't, from what I'm reading, and I'm sure what you're seeing, we're not going to see a huge drop in values. I mean, what's the worst drop we could probably have? Maybe, let's say even if it's 10 to 20% drop, let's say there's no stimulus package, you know, January comes, evictions are happening, you know, or let's say sellers, let's say there is no stimulus, the eviction moratorium stays, let's take that back, you know, and landlords have to sell. If anything, you know, with like, let's say TCS, Audica Homes, or other private equity firms, they're going to stabilize the market. So as a homeowner, you're not going to see a huge drop, or even as a landlord. I mean, am I on the right path? Do you agree with me on that?
Well, yeah, I mean, for what we manage, like I said, more of the workforce housing, you're seeing the market, I mean, the rental market, as far as rates go, they're increasing still. There's still a demand for workforce housing that the rent rates are going up. The luxury market, you're seeing people, seeing stuff sit. People are in the luxury market are, leaving the city, moving for the suburbs, which is again driving suburb prices. I mean, almost every home that I know, at least in my area, I live in southern New Jersey, is going over ask and sells within a week, is under contract. I mean, I know one agent, 6 hours went under contract over ask for a home in the suburbs.
Wow.
So within the city, that rent values are increasing. In the luxury market, they're stalling or taking a little dip. But again, they're increasing in the suburbs as far as single family goes, because people are leaving the city that might be living in the Class A asset.
Okay.
So you see like a bright future for the affordable housing
Yes.
as a whole, right? Yeah.
There's always going to be a demand, right? So like, say we did go back to 2008. Say that stuff was so bad that people, there was mass unemployment. If anything, people, they still need a place to live, right?
Mm-mm.
If anything,
Absolutely.
downsized. So you're still going to have that demand. At least that's my opinion. You're always going to have people that need to downsize and move down, as opposed to increasing.
Yeah, that makes a lot of sense. So, in terms of now let's talk about, like, maybe it's not a housing crisis per se, in terms of we're going to see a huge drop in values, but what I'm thinking is, and I'm not the only one, but I think it's more of a ownership crisis, affordability crisis happening. Whereas a lot of Wall Street firms, they want to get in, they want to buy. Once this eviction moratorium is over, mortgage forbiddance, they're getting ready. I mean, they're getting very creative with these strategies. They know that owners are they're equity rich. I mean, they're talking about creating strategies like sale leasebacks, which is really commercial type of deals, but now they're going to do it for single family homes, and it offers a solution, or they're just buy it. So if anything, we're not, do you think that we're not going to see a lot of foreclosures coming? I mean, with better, considering the inventory with the better underwriting, right? We're going to see, but if anything, we're going to see a lot of Wall Street firms buying, where they may push up the prices more, even if we have more. Let's say we do have a lot of there's a backlog of foreclosures, even if that hits the market, and then the properties that they're like I said, they're equity rich, cash poor, maybe just sale leaseback, maybe it's just a purchase. If anything, there's a lot of private equity money coming into the market. So we just had a webinar about this, was it about a month ago, about how only single family is only owned by 2.2% of institutional investors. They're already gearing up to buy more. In fact, this pandemic has fueled them. They're so optimistic now. They're optimistic before the pre-COVID. Now they're even like, whoa, this is like they're I mean, they have so much money on the sidelines. They're getting ready. So if anything, they're probably going to buy. They're going to be buying more and pushing up prices, which is going to drive home ownership. When I say home ownership crisis, it's going to be the American dream of owning a home is maybe it's not going to be there. It's changing, you know?
Right. And then it's catch-22, right? So values go up, you're paying more for the home, which means you're going to have to, the rents are going to increase.
Yeah.
Wait, if wages don't increase with it, I mean, that could be that's a whole nother talking point, is what would happen then, right? But yeah, like you said, there's I read every day there's big banks that are just gearing up. I mean, we were joking about it, that, you know, one bank said, oh, we're going to dip our toes and put 300 million in the SFR market. And there's a lot more behind it. I mean, there's people that, yeah, see it, they see the value, and they're either getting in now, or like you said, they're waiting. They have a lot of capital, and they're just waiting to deploy it when the time's right, if, you know, hoping that maybe prices do decrease a little more too.
Yeah.
But again, it'll prop it up. I mean, the demand right now is, it's really unbelievable still. Like I said, stuff's stalling a little bit. Could be seasonality too with the holidays. I mean, it's normal, it slows down. But I mean, I get calls, people that aren't even really interested in property management at the moment. They're just calling property managers in the area, seeing if they have any inventory for sale.
What's for sale?
Because
Yeah.
it's so, inventory levels are so low, even in, you know, the type of assets we're talking about, investments, that, I mean, that's what's keeping the values up. There's nothing out there right now.
Yeah. So even if there is an influx of, let's say, foreclosures, you know, they're talking about shadow inventory coming to the market, but there's so much demand for this workforce housing that, if anything, we're not going to see that dip in workforce affordable. But in terms of, let's say, the luxury product, that's a different animal. You know,
Different animal, like Class A apartments, things like that. Again, Philadelphia, though, once we're out of COVID, I think that demand will pick back up again, because what we're seeing is a lot of people leaving New York and heading down towards here. I mean, people joke, but they're talking about building a direct high-speed line. Basically, Philadelphia will be the next suburb of New York City. And you're seeing a lot of people from New York. I mean, I know a few people too that pre-COVID lived here, commuted to New York every day, just because of the ease of the train, and they're trying to make it even quicker. So again, for where we're at the moment, where we're located, it's the perfect storm, you know, of increasing values of homes, and it's just a desirable place to be. So yeah.
yeah, and Philadelphia. Yeah, I was reading too that New Yorkers are fleeing in droves. The affordability in Philly, it's you know, let's say you get a luxury townhouse. What is the rent? It's like maybe $3,000 a month, or
Depending, I mean, could be 3,000, could be 4,000, could be as high as 7,000.
and this is like a 3-4 bedroom, both.
Yeah, I mean,
three stories.
depending on what area you're in, yeah. Could be 3, 4. Like I said, I've seen them upwards of 7, but 3,000 to 4,000. But in New York, at least pre-COVID, what was it like? I mean, I can't really personally speak on that, but you're probably talking what, like 10 grand a month?
Yeah, you're talking a very you could be making 6 figures in New York, and let's say you're in the New York Manhattan area, you're just getting by.
Right. Six figures.
100,000, you're getting by.
You're probably living paycheck to paycheck in New York
Yeah.
if you were just making 6 figures, because, you know, the cost of living there is so expensive.
It's ridiculous. Yeah.
I've seen reports, as you know, that you know, obviously that the rents are decreasing there, but I guess Philadelphia's on the map now. So
Yeah. No,
demand.
I mean, you have a lot of I mean, this is a whole other topic we could talk about, just to Philadelphia in general. But this is good stuff, that what we're talking about. You know, that market is a good market. Obviously, different markets may have, it's all the demand drivers, right? You have the high speed rail, you have employment there. It's a major city. you know. And if anything, you know, what's interesting is you're seeing a shift of the urban to the burbs, right? But maybe you're seeing urban to another urban city like Philadelphia. That's what we're
Correct.
seeing.
Correct. So you're having, urbanites here in the city want to go to the burbs, but then you're having urbanites from, say, New York that want to relocate and just live in the city as well still. I mean, I can't really speak in too much detail because I don't know the markets that well, but I mean, I just saw a report the other day too. I mean, look at Texas. Influx of Californians moving to Texas. I just saw Hewlett Packard is officially moving their headquarters there too.
Was it which city? It was I know you have like San Antonio, Austin.
So I think Austin's
hot.
Oh
Yeah, Austin's
and
booming.
Dallas.
Yeah. Dallas is a hot market.
Dallas is. I mean, a lot of people are moving their headquarters there.
Yeah.
So you're getting a lot of Californians that are relocating from there to Texas.
They have an exit. They have an exit tax.
Right, which is like New York. You're going to two places, at least what they say on the news. You're either coming to the Philadelphia area, or you're going to Florida.
Yeah.
One or the other. So
I guess really what it comes down to, you know, we're talking about this is great that we're having a conversation. I love the openness of how we're just having a conversation. But so going back, so we, you know, headlines, you see a lot of YouTubers, videos, oh, foreclosure crisis. I go to the gym, some guys like, oh, the something apocalypse. He's talking about the real rental apocalypse coming because of, or because of eviction board, like, you know, going back, we don't, like, as a landlord for residential, let's say workforce, we're not gonna see that. You know, we're thinking that long term it's going to be even more demand. I mean, even rentals in general, long term, there's just going to be more demand for rentals because the affordability is really, you know, it's the gap is shrinking because the wage growth has not kept up with rent growth and also the values of the house, the appreciation, you know. So if anything, you know, and interest rates dropping is pushing up the values. So really, we're going to probably see more renters, less home ownership, and we're going to see an influx of more Wall Street private equity for buying up single family homes. So in terms of values, you know, what I'm thinking is, or maybe everybody here agrees with me, is that we're not going to see like a crash of single family homes, like a big drop. Maybe we see a little hiccup, maybe a little bit, let's say worst case scenario, 20%, which even at 20% drop, you're not going to, like, all your equity shouldn't be wiped out still, right? Am I?
Well, it all comes down to when did you buy?
When did you buy it?
When did you buy as well, right?
Yeah.
So, like, you know, how many people are putting, you know, when you're talking millennials too that decide they want to purchase and not rent, most are putting down 3.5% first time home buyer program.
FHA, yeah. It's guaranteed. So,
right. But even then, like, yeah, it's guaranteed by the government, but it all trickles down, right? Like, the government just keeps throwing money at stuff, but eventually someone's got to pay for it.
Yeah, well, yeah, the government's, I mean, that's usually what happens. We spoke about this. There's always a deregulation, you know, back in the 80s, 90s. That's how a crisis happened. Government comes in. There's all these incentives. Investors come. 2008, same thing happened. 2012, SFR stabilized. It was a free fall. Then the institutional, the Blackstones, they stabilized the market. Bring the values back.
And then an interesting thought just crossed my mind too. The refinance market's so hot right now because rates are so low, right?
Yeah.
And values up. How many people are pushing cash out refis?
It's hot. I talked to mortgage. They're like, their phones are ringing off the hook.
Right. Like, so that could, again, there's a lot of unknowns, right? Don't have a crystal ball, but like just, having a conversation with you both. What does that look like? I mean, that could be a whole nother wormhole we could go down, but like you said, if values drop, people refi, do cash outs. Now their values are gone.
But they should have some liquidity because in order to refi, you got to have good credit. You have to have liquidity. I mean, banks aren't just like taking your word for it.
No,
You know?
right. Like they're stricter underwriting.
There's no more fraud. I mean, we're not dealing with
Right.
like originators talking to the appraiser, say, hey, you know, we need this to appraise for X amount of dollars because we got to cash our refi this much. You know, we're not seeing
Right.
that. You know,
No. But yeah, I guess it really just depends on how big of a drop the value is, right? So
yeah, I've been reading. I don't see a big drop, even a 20% drop. Let's say worst case, you know, it's not the end of the world. You know, it's
true.
and it should bounce back because I think that if anything, you know, well, if we do see that, I think there's going to be a lot of money going in, like the Wall Street money or even mom and pop investors. I mean, look, you know, there's so much financing available because really the buyers comes down to the financing available. And remember, we had this situation with TCS where we opened up Fund 3, and Daniel, managing partner. So people who are listening don't know Daniel Edry's a managing partner in TCS Attica Homes, the private equity firm. They want to buy thousands of homes, and we right when COVID hit, we opened up Fund 3 to take advantage of buying distressed properties. We were hoping for a 15-20% discount. Lending dried up. There was no liquidity, so there was less buyers. If there's no debt available, there's less buyers. Daniel wished he would have raised the money faster. As soon as the liquidity came back, the buyers came back, which means which means, you know, so that's another thing that happened too. So the mom and pop investors have access to cheap money. They have access to Wall Street money to buy, rehab, refinance into a rental loan. I mean, there's so much lending products available for the SFR space that wasn't available a decade ago. So that should help stabilize the market as well. And I don't think, as a lender myself, I mean, look, COVID was like a shock to the whole market. Everything just shut down. But now, you know, what I'm thinking is that let's say they do start shutting things out. I don't think it's going to be much of a shock to the financial system when we're talking about liquidity with the secondary markets in terms of financing. I don't think it's just going to just evaporate overnight, you know?
No, it's not going to be like '08 where it was overnight and that was it. Especially now we've been through one lockdown, full lockdown. They've learned what to lock down, what to keep open as well. What, you know, rethink what's essential, what's not. So I think they put more, you know, guidelines in place, but at the same time, like you said, that I don't think it's not going to be. I don't think it will be a full shutdown.
Because what I'm seeing, because in March they shut everything for the private lending space, right? So
I mean, everything. The world just stopped, right? Just stopped.
And what I saw happen was, it's really interesting. So when the lending came back, when Wall Street money got back into it again, the biggest struggle is how do you determine the values of the underlying assets? So basically, investors had to become confident of investing in, because, you know, this is a lot of institutional money investing in this case. And then they had to figure out, how do they price these loans? What do investors have the appetite for? So originally when the lending came back, the boxes are very narrow. You needed stronger credit. You had to put more money down. They were requiring interest reserves. And what I'm seeing now is, I know Daniel is seeing it because, you know, with TCS, the credit boxes are widening again. So lenders are becoming more bullish now in this SFR space. I mean, everything is back. And so that, to me, tells me that they're not expecting a hazard. If they were expecting the world coming to them, do you think they're going to start opening up their credit boxes again? I don't think so.
Lending would be so tight. I mean, no, it's a very good point.
Yeah, that's what I see. And I see, you know, Corvest. I mean, that's who TCS borrows from. I mean, they're borrowing. I mean, already they shut down. They're back full operational. You have the agency debt, like let's say Arbor. I mean, Arbor. They have a whole suite of products. I mean, this is all. I mean, they're backed by Redwood Trust. I mean, they shut down Redwood Trust. Now Redwood Trust. I mean, if you look at the I actually invested in their stock at one point, did well on it when it took a beating, because I knew when the stock dropped it was going to come back. But they're a mortgage REIT, and they own Corvest, right? So what's interesting is they have a buy rating. I mean, analysts are bullish, on Arbor. They're also bullish on, like, let's say Redwood, which tells me which tells me that we're very bullish on the space on rentals, especially SFR. So I don't. So if the lenders aren't, if the lenders are bullish, and investors, like, let's say us, then this whole thing about 2021 crisis, it's just people just talking. I don't think, like, there's no crisis really. It's not going to be like, everything's just crashing down. Maybe retail, that's a different story, or hospitality. That's a crisis.
Yeah, I mean, retail and commercial space right now, yes.
Office is another unknown. Office, but the residential, like, I'm reading these. That's why I want to do this video with you, because I'm like, I don't see it, like, what people are talking about.
Well, think about, too, on larger scale, retail, right? Malls. Most people are walking malls now that have closed down to convert them into apartment buildings.
I read that too.
Mm-hmm.
I was even reading in New York, they're taking office and making them apartments.
Yeah, I mean, the rental demand's there. You got to get creative, right? So. Yeah,
so I guess that's it. For our listeners, like, don't, if you're an investor, like, don't, like, look, you got to study your market. Like, you have to have contacts. Like Tei and I, we have Joseph with TCS. So we have a pulse of what's going on in the market. It's all about your relations and who you can speak with. Like, don't just read the headlines. Everybody, you have to understand, when people write news, they're writing news because they have to put out information because they get paid by advertisers. So that's why you always see, and then what sells? Bad news, right? Yep. I mean, it's just the nature. People they love to read bad news, right? But the terms is, like, and then you see a lot of YouTube videos, like I said, like, housing crash. But in reality, you want, like, if you want to build wealth as an investor, you want to, rentals is especially residential. Anything, it's very, very, we're very, bullish on the long-term fundamentals of it. Could we see a little volatility, let's say, come January or whatever? Like, yeah, I mean, yes, but we don't think we're going to see, like, a black swan event where, like, all of a sudden, like, the market's just going to just dip, it crash down, and we're not going to see an increase for some period of time, like a long time. You may see a little dip and it just comes back.
And people were bullish on rentals before COVID as well. I mean, they were building, when I go to these conferences, the big talking point was build to rent communities.
Build to rent, yeah.
So, you drive through the suburbs of certain cities. I know outside of Phoenix, there's a lot. Down south, there's a lot going on. Neighborhoods that would typically be your $300,000, middle-class single-family home, they're building neighborhoods like that, but just for rentals.
What's interesting too is so, like, we're talking about affordable rentals, but now let's talk about suburb houses, right? So what I think is interesting is that, usually, let's say you go to Hoboken, New Jersey, you have an expensive apartment, or even New York, and you have a bunch of millennials who they're sharing, they're literally, one has the master lease and then they just sublet, The same thing can happen in a single family house. In fact, my father has a McMansion in Colts Neck. You wouldn't believe it. I think he's charging, like, I think it's like almost $8,000 a month. But there's roommates. It's a 5-bedroom house. If you have 4 people in there, do the math. It's affordable, and you have a big house. And what's really interesting about this story is these are people on TikTok. They have to show people that they live this lavish lifestyle, living in a big mansion in Colts Neck, New Jersey, like a big house. And they got to show people. So basically, you have all these YouTube stars, Instagram, TikTok, that they're renting McMansions. So it's a whole new market that just opened up that I never even thought of that you could even have. for a house. We're talking about almost a 8,000 square foot house.
Yeah.
You know, and there's actually a rental market for it. People will pay that. But think about it, people paying that in New York City. Now you could come to the suburbs in a nice town. I mean, you're talking about it's over like almost an acre lot. You know, a big backyard. I mean, you have there's no pool, but you can always put a pool there, hot tub. You know, home office. I mean, you have 5 bedrooms, a big basement, a walk up. And that's the new thing. People are working from home. So I think there's a whole new opportunity for suburban rentals. And what would you rather rent? A little apartment or a big house?
And we're seeing that in the city too. So we work with a lot of developers who, you know, are building to hold for a little bit before they sell it. And it's the same thing, right? Like normally you'd have someone that would just go into a 1-bed or a studio. Now they're getting some of their friends and they're moving into, you know, a brand new 3-bed condo or townhouse because you know, the rents may be a few grand a month. They'd rather have the space, like you said, even if it's in the city. You have a nice townhome with a couple of your friends. You can afford it instead of living, you know, in an apartment by yourself.
And that's exactly my father owns a few houses in Center City, and that's exactly what's happening. You have millennials. Let's say the rent is a 3-bedroom house, 3-bedroom, let's say 2.5 bath, 3-story. We're talking luxury. We're talking like granite countertops, Bruce hardwood flooring, you know, vaulted ceilings. You were talking like something really nice. I mean, this is brand new. I mean, it was built, let's say, 8 years ago, 7 years ago. Like he bought at different times and built these houses. But yeah, exactly. You have 2-3 people living in there. Maybe they're students. Maybe they're millennials are working, and they're you know, and it becomes affordable. The rent when you're paying, you're chopping up a $3,000 a month between 3 people.
Correct.
It's not a lot of money, you know, and you got a beautiful house. It's beautiful. And probably with the social distancing too, people don't want to live in an apartment building, going, you know, vertical, you know, you want to be
bubble.
You want to be spread out. You want, you know, so this is really good stuff. I think it's a lot of good stuff we're talking about. So for listeners out there, the rental market is not coming to an end. The people that make it hurt are the ones that are over leveraged, the ones that don't have reserves to cover themselves. Joseph, you want to give any tips for before we go on, you know, current landlords that, you know, that are dealing with problem tenants, and then maybe some property management tips, because, you know, hey, that's what you're an expert at, you know, and for listeners out there.
I mean, a couple things is just, you know, make sure you have your documentation right. Stay on top of everything. Be organized. I mean, at this point, you know, if anyone's delinquent, just, like I said, keep your documentation, wait out the storm. If you're looking to acquire, you know, be patient. But definitely, even if it's not with us, but with someone, what helps you expand further is hiring a good property manager, because it frees up your time to look for more investment opportunities and to really focus on that, because where you make your money where you buy, right? So, you know, partnering up a good property manager definitely frees up the time and takes the stress off, and can help increase your, you know, your return on investment.
And then also you mentioned about screening of tenants, you know,
Right.
You want certain you want to try to avoid certain employment.
Well,
or
you know, with all the fair lending laws, you know, you got to give everyone a fair shot. But when you're doing these underwriting, a lot of investors that we've noticed are paying attention more to what industry the applicant's in, more than ever now. Like I said, it's always the default is 3 times the rent, you know, income per the rental rate. No evictions in the last 5 years is typically what we look for. The biggest thing too is job length, but even more so now, what's important is what industry they're in.
So going back to landlord tenant laws is very important. So you cannot. So someone's like, "Oh, I work at mom and pop restaurant that can't open up, you can't say no to them because of the yeah.
Right. Like one, you want to be respectful, and two, yeah, I mean, you have to give everyone a fair shot, right? So, yeah.
But landlords, obviously they're going to make a decision. I mean,
they're going to make their decision no matter what. Yeah.
It's kind of like a gray area in a way. It's like, okay, well, we
right,
have
like right, like they're the behind closed doors, they'll thinking one thing but might say another. But yeah, I can tell you that they're definitely paying attention to that.
Yeah, it makes a lot.
But let's say like if there are two prospective tenants, right, who's interested in like moving into your landlord, the customer, then can they actually like decide to who they want to go with depending on which industry each tenant is in?
They could, and they could just say we're just picking someone over the other and just declining that applicant.
Yeah, you're not going to you're not going to say, yeah, we're declining you because you work at this place. We don't like it because we feel that you're going to be unemployed within, we can't say that, but but landlords are thinking this. Property managers, you have to respect the laws, but behind closed doors, what they're thinking, they're obviously going to be more selective. They're going to start looking into that more.
Which is understandable from landlord perspective. Yeah.
But you can't say was it redlining? I guess you can't say, or that redlining is for. You can't say we don't like you because you're this demographic or whatever.
Correct, and you should never do that anyway.
Right. Anything else? Any other tips? Because I know we've been on here for some time. We have a lot of good golden nuggets. Anything else, Tei? You want to have anything else for?
No, I mean, this is a really great conversation. So we get a lot of good insight perspective on what's going on in your business. So, I mean, I just want to thank you for making time amid the hectic schedule and then share your insights. So yeah, really appreciate it, Joseph.
Yeah, no, I greatly appreciate it. I mean, it's amazing to have someone like I have your cell phone number. If I have a question or Tei has a question, or it's always good to have these type of relations, because real estate relationship business is always good to have relationships, especially with property managers. I mean, if you want to invest, you should have a good property management company, even if just to have them as a phone call away to ask questions before you make your potential acquisition, because they know what's going on.
Correct. Yeah, we do that all day. That's just an added resource. But no, hey, it's always a pleasure talking to you both, and I appreciate the time. And to everyone, happy holidays, and hopefully.
And then if people
better 2021.
But exactly. So for future landlords out there that are looking to start getting into real estate, or maybe existing ones, tell us a little bit more about TCS, where you manage your expertise, just how they find you.
Yeah, so we manage about 3,000 units, headquartered in Philadelphia. We do Philadelphia, the surrounding suburbs, northern Delaware, southern New Jersey. You can find us at tcsmanagement.com. And all our contact information's on there. Like I said, even if you're looking to get in, or you're in and you just need another resource, we're always here. And you can find my contact information on the website, and I'd be happy to share. If it's not me, there's an abundance of knowledge that that has way greater knowledge than me within this building, that we could definitely assist anyone with.
Yeah, we'll put the link down below for your contact information. And you service where? You service Philly, New Jersey, what areas? So
Philly, South Jersey, so Trenton, South, basically Philadelphia and a 35-mile radius. So Delaware down to Newark, Trenton down to Salem County, Philadelphia and the burbs out to Pottstown. Okay,
good to know.
Yeah.
And I noticed you guys have a referral program too for people as well.
Correct. So if you're a licensed agent, we're happy to work with you. Get a referral fee, sign non-competes, for, between us and you for your client. And we're just another, added resource for you, for your brand, kind of so you can become that one-stop shop agent for your investor clients. It's just another service you can offer to them and have a trusted partner to do property management, which in return we find helps people do more transactions.
And another note too is let's say you're a potential syndicator, right? And you're looking for, like, if you're trying to build a team, right? The first thing you really want to do is you gotta have the right. I mean, let's say you're looking to buy and manage. You gotta have the right property management company, because your investors, they need to be confident that that you could actually manage an asset class similar to it's not like your first rodeo managing.
Correct. The business has been around for about 8 years now, 8 to 9 years. There's a wealth of knowledge in this building from the partners. I mean, all the way down to the actual day-to-day property managers.
And you have some larger clients too.
We do. We have some institutional clients that we deal with, have weekly meetings with, manage a couple hundred properties in their portfolio each, and they continue to expand, and we expand with them.
That's an important factor. So the audience, if you're looking for a management company, you want to look for one that you want to know who their client base is. They have institutional clients. That's a good sign that this is the right company to go with, because a larger private equity firm is not going to just go with the small mom and pop shop. So important.
Right.
Yeah.
But at the same time too, we welcome the mom and pop investors as well.
Exactly.
That's our bread and butter of the business. And we love just dealing with, the one-off or accidental landlord too.
So you do both. You do large institutional. You also do the mom and pop. You're a family-owned business. You're very easy to get a hold of. I know that we're pressed for time. You have to get back to what you're doing. You took an hour out of your day, or more than that, with us, an hour and a half. Thank you so much, Joseph. Really appreciate just having you here. We want to have you back on, and I hope everybody, if you have any questions, feel free to leave a comment below, ask questions. If you want to reach out to myself, Tei, Joseph, just leave a message, answer, you can comment below. But thank you for everybody for listening. Thank you, Joseph. Thank you, Tei. And until then, we'll see you next time. Happy investing.
Yeah. Happy investing, everyone. Yeah.